years, including 11 years as the editor of Mining News, and she's a two-time AMEC Media Award winner, and in 2015 was the recipient of the prestigious Diggers and Dealers Media Award. Kristie is also a volunteer member with me on the Melbourne Mining Club Steering Committee. And today she's tasked with engaging our guest, Julian, in some conversation. So welcome, Kristie. So I'd like to introduce John Tivy, partner at White & Case now, to introduce our guest speaker, Julian.
Members and guests, Julian Andrews has been at Deterra Royalties from the time of its listing, taking the role of Managing Director and Chief Executive Officer on its demerger from Iluka in 2020. He has over 25 years of experience in diversified corporate investment, including infrastructure project finance, as well as capital raising, mergers and acquisitions across the mining, energy and chemicals industry landscape. He began his career in Canada with PwC before moving to the USA to work in project finance and corporate advisory. He returned to Perth in 2004, where he joined Wesfarmers' in-house corporate development team. During his 13 years at Wesfarmers, Julian held a range of roles, including General Manager, Business Development, and Chief Financial Officer in Wesfarmers' Chemical, Energy and Fertiliser division. He left Wesfarmers in 2017 to join Iluka Resources as Head of Strategy, Planning and Business Development before taking on his current role at Deterra. Julian holds a Doctor of Philosophy in Business from the University of Alberta and a Bachelor of Commerce with Honours from the University of Western Australia. He is a Chartered Financial Analyst, charter holder, a graduate member of the Australian Institute of Company Directors, and has completed the General Management Program at Harvard Business School. Julian is also a die-hard ice hockey fan, a legacy of many long, cold winters on the Canadian prairies. Members and guests, please welcome Julian Andrews to the stage of the Melbourne Mining Club.
Julian, welcome again to the Melbourne Mining Club. It's nice to have you here.
Thank you.
So Deterra is Australia's only substantial listed royalty company. Can you tell us a little bit about who Deterra is and how it came about and what you do?
Yeah, sure. Look, we are, as we heard in the introduction, we're a relatively new company. We were created back in 2020 when we were spun out of Iluka Resources. And really, we were spun out with, it wasn't a separate business within Iluka, we were spun out with a handful of royalty assets, and in particular an asset that we hold over one of BHP's operations in the Pilbara. And effectively, we were spun out with a mandate to look to grow a different type of business here in Australia. It's a business model that's been very successful in other parts of the world, particularly in Canada. But effectively, it's a company that holds portfolios of royalties and streams, provides its investors with exposure to mining activity, but a qualitatively different form of exposure. It's much higher up the P&L. Typically the exposure is at the revenue line, so you get exposure to commodity pricing and as well as production volumes. But at the same time, we're spun out with a small portfolio and we're looking to grow that. And I think probably what's particularly relevant for the discussion today is that part of the business model is really to act as a form of funding to the mining industry. So we have a mandate to look to provide funds to miners to develop new projects in exchange for providing new royalties and streams.
So as you mentioned, the royalty sector in Canada is huge. Yeah. So why do Australians hate royalties?
Yeah, Kristie, I think hate is quite a strong word, but look, I think we can all agree that royalties don't necessarily have the best reputation in Australia. As you say, they're much better understood perhaps in other industries and in other jurisdictions. So I was just chatting earlier at lunch, and in the oil and gas space, I think royalties are very well understood and very widely used. In the mining space, less so. Certainly here in Australia, there is a real history in other parts of the world, and particularly Canada. And you mentioned that it's a very well established sector over there. There is a history of companies looking for alternative forms of funding to help them get their projects built. That's not the case in Australia, and certainly I think that's one of the things that we'd like to change. Quite why that is, I'm sure there's a lot of different reasons why. Perhaps there's an historical element to it, in that sometimes you can have a project that has a royalty on it, and it really came about through the exploration activity. So it's often an inherited royalty that sits over a project. But I think when you look at other countries, and there are some really strong examples of royalties and streams being used to enable a project, to get a project built that otherwise wouldn't have been built. So that's our goal. We talk to the market and the industry as much as we can about how they should be thinking about royalties, how royalties can be used really effectively within a broader capital stack to provide a much more efficient funding structure for a project.
So you own probably what is one of the best royalties in the world. Yeah. Can you tell us a little bit more about that?
Sure. I mean, there's no question. We really are very fortunate in terms of the assets that we were gifted with on our listing, and key amongst them is a royalty that we hold over BHP's Mining Area C operation in the Pilbara. I'm sure you're all familiar with Mining Area C. It's currently going through an expansion through the South Flank operation, and when it's complete, it's going to account for something like 8% of global seaborne iron ore trade. Now we have a royalty interest on that at the revenue line, so we're entitled to a payment of 1.232% of the revenue that generates. We also have a secondary interest in it, which is a capacity payment, which is effectively we get paid an amount of $1 million per 1 million tonne increase in the capacity of the overall operation. So just to put that in context, last financial year that royalty generated over $220 million in revenue for our company. So look, you say it is one of the best. We say if it's not the best, it's certainly a podium finisher. From a scale perspective, I think from a quality perspective, when you look at who the operator is, BHP, obviously, absolutely world-class operator. The location of the mine, the scale of the mine, its position relative to its customers, and really importantly, the longevity of the mine. It's a multi-decade asset, so it's a fabulous asset to have. And it's actually it's a really interesting example of how the royalty model can work, because the genesis of that royalty, as I said, we inherited it from our spin-out from Iluka, but the genesis of that royalty really dates back to the early 60s, where, which was the original opening up of the Pilbara, the iron ore in the Pilbara. And one of Iluka's predecessors companies, if you sort of trace back through the various corporate transactions, was a member of the Mount Goldsworthy Mining JV. And over time, that operating interest morphed into a royalty interest. So that royalty was written in the 90s. I think even when Iluka was created through its merger at the end of the 90s, there was really only a nominal valuation placed on that royalty. BHP and its partners invested in opening up the North Flank in 2003, and then the South Flank opened up in 2021. And as a result, we've been able to sort of participate in that growth without having to make any additional capital contribution. And we're now a company that with a market cap of, depending on the day, somewhere in the order of $2.8 billion, which is largely really driven by that asset.
Back to Canada, Franco-Nevada's probably the global name in mining royalties. Given Franco and a lot of its peers tend to focus on gold and precious metals, is that an area that you are also looking in, the gold space, or?
To be honest, probably less so. I think not that we have anything against gold, and if we saw some good opportunities, we'd certainly be interested in funding them. I think, for us, at the end of the day, we're a relatively small team, and we need to focus our attention where we think that we've got the greatest chance of success. As you said, I think there are some really high-class royalty companies that do focus on gold and precious metals, and so that sector of the market is really very well served. So again, perhaps to just put that in context a little bit, when we look at the publicly traded royalty and streaming sector, there's about $60 billion worth of market capitalization of companies focused on gold and precious metals, and somewhere between sort of 5 and 8 that focuses outside of precious metals. So we focus outside of precious metals because we think, why go up and compete against, the very large players and a lot of other capital that's chasing those same opportunities. So our focus is very much more on the bulk and the base and the battery metals.
Obviously, the rise of critical minerals has resulted in a lot of new projects, new commodities that need funding. How do those, like the large fluctuations in critical minerals prices that we've seen lately, for instance, lithium, how does that shape your thinking as a potential financier?
Yeah, I think it's short answer is we see it as an opportunity. I think that we've certainly seen some examples of pretty severe volatility in pricing and the impact that can have on projects and particularly funding for projects. From our perspective, when we come on to fund a project, we're looking at the life of mine. And often if we're getting involved in helping fund construction, that can be 2 or 3 years down the road before we see production. We're not like debt, where the banks they are much more focused on price decks, and I think understandably so. They're concerned about the company's ability to meet its repayment schedule. We're not like that. When we're talking about taking a small percentage interest in the performance of a company, we have much better alignment in that regard. So we're able to take a longer-term view, a life-of-mine view of where pricing might go. We're not looking to earn our return over the first 5 years of a project, so we can take a longer-term perspective on pricing and less driven by short-term fluctuations.
You touched on it a little bit just then, but what is the main, difference between royalty financing versus debt or equity?
I think it's a very interesting conversation to have. When, as I said, we touched a little bit on the difference with debt. We come in and I think the key advantage relative to debt of a royalty is that it is aligned with the owner interest, in the sense that we get paid when the mine is producing. We don't get paid when it isn't. So if there are short-term fluctuations in cash flow or production issues or delays in startup or whatever it might be, we're sort of sitting there alongside the owner. We're not going to put a project into cash lockup or start sweeping cash out of it, or being focused on covenants, or the worst case scenario, actually taking the asset back. That's not what we look at. So we have a qualitatively different interest in the project. So we tend to think of ourselves coming in sitting somewhere between debt and equity. I think one of the key elements where we can distinguish ourselves from equity is that, as I said, when we think about the return that we earn from our investment, it is over the life of mine of a project and lifetime production. So we're focused on the project. So we do our assessment of opportunities based on the NPV of the project. Equity markets, if you're going out looking to raise capital from an equity market, typically you're looking to raise it at a discount, but at a discount to your market value. And so you're not raising off the back of the NPV of the project, you're raising off the back of a share price. And often there can be quite a significant difference between the two. So we see that as a real point of difference. But typically, we will be situated somewhere between debt and equity. And I think it's important to be very clear that, we don't see ourselves as all of the answer. We'll be part of the answer. I think, we're very complementary with other forms of capital. And, we think of ourselves as coming in and sort of replacing that incremental dollar of debt or that incremental dollar of equity often, rather than the first dollar, and helping be part of an overall capital stack that can be more efficient and more effective for that project. And, that's another point of difference, because every royalty instrument is unique, so we're able to structure an instrument that works for a particular project. Often when you talk to banks, they'll come and you tend to get a term sheet, and there's not a lot of room, not a lot of sort of degrees of freedom in the negotiation beyond pricing.
So when you're talking to, developers, I'm guessing the conversations that you have with, North American developers are quite different to the conversations you have with Australian developers.
Yeah, absolutely. As I said, I think, when we're talking to developers, and to be clear, we do have a global focus. We certainly do look at opportunities in North America and South America and Europe, as well as Australia. Tend to focus on the more developed mining jurisdictions, but as I said, there's a history of use of royalties as a funding instrument. It's another arrow in the quiver for CFOs. When we talk to CFOs in Canada, if they're looking for funding, they'll phone their banks, they'll phone their brokers for equity, and they'll phone the royalty and streaming companies as well. That's not the case in Australia, and I think that's something that we're certainly looking to try to change, because we think there is a role. It's also interesting, we have very different conversations in North America in particular with when we're talking to our investors, because excuse me, in North America the business model is very well understood, but they don't know our assets as well. I think here in Australia they understand our asset very well, but they don't understand the business model quite so well. So we have different discussions on both fronts.
And do you find that you get a lot of companies coming to you, or you seek them out? How does that sort of mix work?
Yeah, look, I think it's both. We certainly do spend some time looking at projects and thinking which projects do we think we might be a sensible partner for, and looking out and seeking to sort of put ourselves forward as an option for them. I think we also, as the company sort of grows and matures a bit, and the brand is better understood, we're getting more opportunities coming to us. I think that's particularly true in the last 12 months or so. The first couple of years through 2021 and well into 2022, capital markets were in a very different space to where they are now. Debt was, for all intents and purposes, pretty close to free. Equity markets were highly supportive. Clearly that started to change towards the end of 2022. And I think, from our perspective, when we think of ourselves as sitting between debt and equity, when debt's so cheap and equity's not far off, there's not a lot of room for us. And there's not a lot of call for additional funding, but there's no question that over the past several months we are starting to see developers having to look a bit further afield for capital for their projects, and think a little bit more creatively about how they might be able to raise the capital they need. And as a result, I think we're certainly getting a lot more traction in those discussions.
How do you see that playing out in the next 12 months? I guess the debt and equity landscape and what that might mean for a company like Deterra.
Yeah, look, I think it's very much more of the same. I think, you know, capital is a lot tougher. I'm not telling anybody here something they don't know. Capital is a lot tougher to get now than it was 12 months, and I don't think anybody's expecting that's going to change overnight. I think also some of the volatility we're seeing in commodity pricing suggests that perhaps we might be you know, a really good option for projects out there as well, in the sense of coming to developers with a perspective of a longer term perspective on mine life and commodity pricing, and being less driven by where a company's share price is right now, more looking at the long-term value creation opportunity.
And when you're screening projects, is there any sort of jurisdictions that you would rule out from the get-go?
Yeah, so we like to joke that we tend to focus on the more developed mining jurisdictions, or as our head of business development likes to say, somewhere we'd be happy to take our families for a holiday. But we understand that it can be quite a crude bar at times, but at the end of the day, we're a relatively small team. We have 10 people in the office, and about half of those are focused full-time on the business development. So we need to be able to move pretty quickly to get to opportunities that are going to meet our investment criteria. So some of those more sort of higher risk jurisdictions, sure, they can offer higher returns, but there are perhaps other people out there who are more willing to take some of that jurisdictional risk and perhaps can price it a little more effectively than we're looking to. So typically we don't look at projects that are based in Africa or in Southeast Asia. But things evolve over time, and I'm sure as the company evolves and our portfolio evolves, our risk appetite will move with that as well.
And what about commodities? I mean, we've talked a little bit about where you'll spend most of your focus, but are there any sort of outright no-go commodities?
Coal, I think, and again, I don't think we're unique in that. We did start very early on trying to make a distinction between thermal coal and met coal, but we found out pretty quickly when we were talking to our shareholders that they only heard coal. So again, we need to put some parameters around what we're looking at. So that seemed an easy one. So look, coal is one. I think we sometimes get often asked about oil and gas. Again, oil and gas is one that we don't focus on, and not because we don't particularly like oil and gas, but understanding and valuing an oil and gas project and a gas reservoir or an oil project is a very different skill set to looking at a copper porphyry or a nickel laterite or whatever it might be. So we try to stick a little closer to our knitting. Yeah.
And obviously you can be sort of the answer or part of the answer for a junior or a mid-tier developer trying to get their project up. What about royalties over existing operating projects? Is that something that you would consider?
Yeah, absolutely, no question. And I think to be clear, we're not too focused on the use of the funds that we're providing. So we certainly see opportunities where there may be an existing company, an existing producer who may be looking to acquire other operations. And one way to fund that acquisition could be through putting a royalty in place, either over their existing operations or over the operation that they're acquiring. Likewise, if you look back over the history of the sector, back to sort of 2014, 2015, we saw a lot of royalties being written at the time for balance sheet repair. Companies that were looking to just de-lever, and that can be a very effective way for companies to do that, a much less disruptive way on the overall company. But to your question about sort of acquiring existing royalties, absolutely. There's a fairly steady deal flow of royalties that do come to market. And they've been, we're certainly interested in looking at those. And, often those can be a company or an individual that holds a royalty really by happenstance rather than a particular strategic decision. And maybe it's come out of some drilling activity that they did, many, many years ago, and it effectively sat in the filing cabinet for a period of time. Generally, companies, particularly operating companies, don't get full value for those. To the extent that the market even gets visibility on those assets, they don't necessarily, they tend to get rolled up in sort of an operating cash flow type valuation exercise. And as I said, typically royalties participate higher up the profit and loss statement. So as a result, they have quite a different risk profile, and we feel they should be valued differently than a sort of a bottom line interest. Taking those royalties and putting them into a specialist vehicle like ours can create value that creates the overlap that means there's something in it for both parties. There's been a couple of processes over the past couple of years that people may have read about. South 32 has run a couple of processes where they sold initially a portfolio of gold royalties that they held. They had held an auction process and sold those. And then again, in 2022, they had another process where they sold some base royalties that they held. And again, we're able to raise some cash off the back of those. And I'd suggest at a level that the market probably wasn't giving them full credit for. So again, it's a good win-win opportunity there.
Yeah. Okay, well, I think we're going to welcome Sally back onto the stage now to facilitate Q&A.
Thank you. Thanks for the fantastic conversation. So I'd like to welcome some questions. We've got 2 microphones in the room. Sam and Richard should be out there. So please raise your hand if you'd like to ask a question. And when you do so, please let us know your name and the organisation that you're from.
Hi, my name's Josh. I'm from the University of Melbourne. As far as recapitalisation of existing assets, what is your kind of look on sovereign risk from that point of view? Obviously, when you're looking at recapitalising existing assets, sovereign risk becomes a larger and larger problem. How do you look at that from your investment point of view?
Yeah, so you're right. I mean, sovereign risk is a key one. It's actually an interesting consideration for a royalty company, perhaps relative to an operating company. So at the end of the day, a royalty or a stream is a contractual arrangement. It's not, you don't have an operating interest, you don't have people on the ground. It is a contract, and you need to be confident that that contract will survive for the life of the project, and if you need to rely on the terms of that contract, you're going to be able to. So when we think about sovereign risk, we absolutely do look at those considerations, and as I said, I think our thinking around jurisdiction is a fairly crude shorthand on that in some ways, in that we do tend to focus on those more developed jurisdictions where we feel more confident on our ability to rely on the contracts.
Thanks, Julian. Colin Moorhead, Xanadu Mines. Just could you give us a feel for the size of company and the stage of development that's the sweet spot? So what's the earliest you would come in, and what size company sort of is where you want to be?
Sure, thank you. So our sweet spot, if you like, is we talk about providing somewhere between $100 and $300 million worth of funding to a project. And that would be part of the project. Somewhere typically that might be 20 or 30% of the total funding requirement. Again, our ideal type, we would love to always come in at FID alongside the project financing, but we also, we do, as I said, we will look at, I guess from a scale perspective, we certainly look at opportunities that are smaller than that, and that's, we're seeing a lot of activity in that space at the moment. It's really just a question of balancing the level of effort involved in executing that against the materiality of the opportunity. And we look at things that are larger as well. It's just there tend to be fewer that are larger than that size. As I said, the plan A or the vanilla is to come in at FID, but we certainly do come in later. And I mentioned that it may be to fund an acquisition, maybe to help deliver a balance sheet, maybe to fund an expansion or an extension. But to be clear, we also do come in a bit earlier. I think that there's a very solid history of royalty companies funding studies, and that's something that certainly we do look at and would happily do. I think for a good quality opportunity. Clearly, as you move further down that, you're introducing different risks and greater levels of risk, so your return expectations need to go up in alignment with that. The very early stage exploration stuff, there are others out there that do that. That's probably not our focus just at the moment.
Thanks, Sam.
Good afternoon. It's Di College from Morgans Financial. Obviously, Deterra generate their revenue and their distributions to shareholders on the back of the iron ore price and what they're achieving from their royalties. So what is Deterra's view of the iron ore price going forward? Obviously, we've heard a lot of issues around China, their growth and everything like that. So the iron ore price has held up quite well. What do you think is going to happen in the future with that price?
Yeah, look, I think everybody's got a view on iron ore price, and I think, at the end of the day, we're a price taker on it. We're not operating, we're not making operating or capital decisions on the back of the short-term outlook. Clearly, our cash flow management and balance sheet does. But, when we look at the quality of exposure we have, we're very comfortable that, Mining Area C is a world-class operation. It will be, when it's complete at South Flank, it will be the largest iron ore hub in the world. It will be 8% of global seaborne trade. It's a high-quality operator, very long life. So as I said, we feel we can provide excellent exposure at the top line to iron ore pricing and production out of Mining Area C. So look, we're not iron ore price forecasters. We're not commodity price forecasters. There are plenty of people around who are quite happy to do that.
Don't forget to introduce yourself. Hello, Julian. Michael Beer is my name. Caterer Potash. First of all, it's a terrific asset. You're trading on a PE of about 18 times, which is a pretty healthy PE for a little company, or a 2.8 billion company. BHP's capitalisation is about 240 billion and yours is 2.8. I'm surprised that BHP would actually be happy just to have that royalty sitting out there. I presume they've had opportunities before. I know you used to work at the Lucas, so you probably know some answers on this one. So I guess the question is, why wouldn't BHP take it back? And the second question is, BHP, as you know, is now focusing big time on potash in Canada, in Saskatchewan, the home of potash really in the world. If they came to you and said, would you consider a royalty over our potash, what would you say to them?
So look, I mean, I can't speak for BHP. I'd never pretend to. I think, from our perspective as a management team, we have a really high quality foundational portfolio, and we're just very focused on building out that portfolio and adding new sources of revenue and to it. So in terms of potash, look, as I said, our focus is bulk, base and battery, and there's no question potash fits within that bulk space, and there are some really high quality potash assets out there, both at an operating level, but also, we have some Canadian peers who hold royalties over some of the Canadian potash operations. Again, if it's a good commodity, we like the commodity. I think at the end of the day, it comes down to the project and whether we think we can add something to the project and put together an opportunity that works for both parties.
Thanks, Sam.
Julian, Hedley Widdop from Lion Selection Group. Thank you very much for your talk. It was always nice to hear from a royalty company because we hear a lot from miners and not from that niche part of financing. You talk about a small team, and there's two tables of graduates here who are bigger than your team, but I suggest you come over and meet them at the end. My question, and I apologise in advance because it is a little bit of a cheeky question, so if you want to have a bit of fun with it, please do. Quite a few royalties are generated through origination. You own the project, you sell the project, you keep the royalty. That's kind of the prospector model. And I dare say your main asset was generated in that way, as opposed to having to finance something along the way. It's originated a while back. So have you ever thought of taking that origination approach? And you may be thinking, do I mean that in the sense of the prospector approach? It's a weak market, there are companies falling in value, you have a strong balance sheet and structure. You may not want to go too close to that, but I thought I'd ask it and give you as much rope as you wanted on talking about alternative methods of BD. Thank you.
Yeah, thank you. There are different models. Let's be clear, there are companies out there that will go, public companies and increasingly private equity providers who will provide a range of funding, and they'll say, look, we'll give you some equity, we'll give you some debt, and we'd like to take a royalty as well, and go that. There are companies that go further than that, where they will actually say, and we'll give you some development assistance, and they will look to effectively incubate projects, and then sell, get the debt repaid, sell down the equity, and retain the royalty. Look, nothing against that model. It's just not our model. We're very clear. I think we try to stay focused internally on where we think we can create value, and where the best use of our time is. As you pointed out, we are a small team, and we focus much more on how can we identify good opportunities, value them appropriately, and provide financial support where we can to get them up. So look, it's just not our model. We're very clear with our investors that we look to provide them with a different risk profile exposure to mining activity by coming in as high up the P&L as we can get, and that's what we're focused on.
And one last question, I think.
Thanks. David Schooler, Southern Innovation. I think you've actually just answered my question, but I'll ask it anyway. Have you looked at royalties in the renewable space? So clearly bulks and batteries are of interest to you in the mining space, but what about wind farms and solar farms?
Yeah, look, we haven't. There are, again, we have peers, and there's one Canadian company in particular who started in similar minerals royalties based, and has actually created a spin out focused on renewable energy. Again, I think it's a really interesting space, but it's not so much where our focus is. I think that it is, when it comes down to it, we think when we look at investment opportunities, like any investor, I'm sure they think, how do we earn our normal return and how do we earn our alpha? For a royalty investor, what really drives those additional returns is that life of mine exposure, and that ability you get to participate in extension or expansion of mines. I'm not quite sure how that works in the renewable space. Not to say it doesn't, but there are those out there looking to apply the funding model to the space. Again, it's not where our focus is.
Thank you. I'd like to welcome Mark Flanagan from EmCee to deliver the vote of thanks to Kristie and Julian.
Thank you, Sally. Good afternoon, everyone. It's my pleasure to give the formal vote of thanks to Julian for participating in today's discussion. Julian provided us with great insight into how the royalty model can be used in the Australian resources sector. In today's high interest rate and tough equity market environment, Julian discussed the opportunities the royalty transactions provide to current developers. With a favourable exposure to the Mining Area C royalty, Julian's future focus on prioritising value-adding opportunities in the bulk space and battery metals space shone through. I would also like to acknowledge Kristie's excellent facilitation of the discussion, providing an interesting platform for us all to hear about Deterra Resources' future. Thanks, Kristie. Julian, on behalf of the Melbourne Mining Club and everybody here, we wish you and Deterra Royalties every success. Could everyone please join me in extending a very warm thank you to Julian for his engaging conversation.